I want you to imagine, just for a second, a dying mall retailer.
We all know the type.
Right. I mean, you know the exact kind of place. The fading carpets, the flickering neon signs in the window.
The sticky floors.
Exactly, the sticky floors. The counter where you used to trade in a whole stack of used video games for, what, mere pennies on the dollar?
If you're lucky, yeah.
Yeah. Now, I want you to imagine that same tired storefront somehow mutating into, well, an apex predator.
Which sounds completely absurd.
It really does.
Yeah.
But imagine this financial behemoth sitting on a cash pile that is literally larger than the GDP of several small countries.
It's wild.
Welcome to the reality of GameStop in May 2026.
I mean, honestly, it sounds like a glitch in the simulation.
It really does.
Because when you look at the raw numbers on paper, they just completely defy the traditional laws of corporate gravity.
Yeah.
You have analysts who have spent decades modeling retail businesses, and they are just scratching their heads. Because the math, it doesn't align at all with the physical stores you see in the mall.
Not even a little bit. So today on the deep dive, we are unpacking an incredible stack of material. We've got recent financial reports, fresh market sentiment data, and a massive Wall Street Journal scoop.
A really massive scoop.
Huge. And our mission is to answer one mind-bending question. How exactly did a meme stock relic transform into a $9 billion investment vehicle?
Right.
And look, the most audacious part of all of this is that they're reportedly gearing up to swallow the e-commerce giant eBay whole.
Yeah, we are looking at a fundamental structural evolution here.
It's not just the stock market being crazy again.
No. This isn't just a sequel to the whole retail trading craze we saw years ago. I mean, the wild market swings of the past, they basically handed this company a massive war chest.
Right, they got the cash.
Exactly. And what we are analyzing today is how they are actually deploying that capital. It is an incredibly calculated and honestly virtually unprecedented pivot in corporate strategy.
Okay, so let's start with what I like to call the illusion of the dying retailer.
Good place to start.
Because before we can even begin to comprehend how a video game store attempts to buy an internet giant like eBay.
Which is still hard to say out loud.
Right. But we have to look at how they even have the money to consider it.
Okay.
And if you look at their legacy retail numbers, the story looks, well, exactly as grim as you would expect.
Yeah, I mean, the top-line revenue metrics tell the classic story of physical media just dying in a digital world.
Yep.
Fewer people are buying plastic discs. It's just a fact.
The numbers back that up completely. So Q4 fiscal 2025 revenue declined by roughly 14% year over year.
Ouch.
Yeah. And Q3 net sales fell to $821 million.
Which was down from what?
Down from $860.3 million the year before. So the core business is visibly shrinking.
Definitely.
But here's the paradox. Their Q4 adjusted earnings per share actually rose 63% to 49 cents.
Right.
I need you to make this make sense for me. Because how does a company lose 14% of its incoming revenue, but see its overall earnings per share rocket upward by 63%?
Well, you have to separate the retail stores from the corporate spreadsheet.
Okay.
What you are seeing there is the result of ruthless, almost surgical efficiency.
Cost cutting.
Exactly. Management has been incredibly aggressive with cutting costs and optimizing their physical footprint. I mean, they are closing underperforming locations left and right.
Trimming the corporate fat.
Right. But the real engine driving that massive jump in earnings per share, it actually has absolutely nothing to do with video games.
Wait, really?
Yeah. It's interest income.
It's just the interest they are earning by letting their cash sit there?
Yes. Think about the scale of the capital we are talking about here.
Right, the $9 billion.
When a company is sitting on roughly $9 billion in cash and cash equivalents, they essentially become a bank onto themselves.
Wow.
In an environment where interest rates yield a decent return on safe treasury bills, a $9 billion pile of cash acts as a massive revenue-generating engine all on its own.
So they don't even have to sell games.
Exactly. They don't need to sell a single game controller to make millions of dollars a month.
That's insane. Let's look closely at that balance sheet, though, because the proportions are wild to me.
Let's do it.
So they have $9 billion in pure cash. But the entire market cap of the company, meaning the total value of all its shares combined, is only sitting around $11.5 billion.
It's an absurd ratio.
It really is. That cash-to-market cap ratio feels a bit like, I don't know, a blockbuster video store that happens to have a winning multi-billion-dollar lottery ticket sitting in its backroom safe.
That's a great analogy.
Right. Like The store itself might be completely empty, but the entity is filthy rich.
Exactly.
But wait, I'm struggling to buy this completely.
Why is that?
Because they also carry over $4 billion in long-term debt on the books.
Ah, yes. The debt.
So with $4 billion in debt looming, I got to ask, couldn't this $9 billion cash pile just be a mirage hiding massive structural liabilities?
It's a fair question, and honestly, that debt load is the primary reason bearish investors have continued betting against the company for so long.
Because it looks like a heavy anchor.
Exactly. But when you look at the sheer scale of their liquidity, it completely neutralizes any immediate solvency concerns.
Because of the cash.
Right. Yes, they have $4 billion in debt, but they have more than double that in liquid cash just ready to deploy.
Oh, I see.
If they wanted to, they could literally pay off every single cent of that long-term debt tomorrow morning, and they would still have $5 billion left over to play with.
So the debt isn't a ticking time bomb at all. It's just manageable leverage.
Precisely. It gives them flexibility. And this underlying financial reality, it leads us directly to what Wall Street analysts are calling the blue sky thesis.
The blue sky thesis. Okay, what is that?
Well, you have to stop looking at GameStop as a retailer.
Okay.
Those physical stores with the faded carpets, at this point, those are just placeholders.
Placeholders for what?
Fundamentally, GameStop is operating as a closed-end fund wearing the disguise of a video game store.
Okay, let's unpack that term for a second. For anyone listening who maybe isn't steeped in corporate finance,
Yeah.
what makes a closed-end fund different from the company we used to know?
Sure. So a traditional retailer makes money by buying goods at wholesale and selling them at a markup.
Buy a game for $20, sell it for 40.
Exactly. But a closed-end fund is simply a pooled investment portfolio.
Okay.
It has a fixed number of shares, it raises capital, and then the management team uses that giant pool of money to invest in other assets.
Like stocks or bonds.
Stocks, bonds, or in this specific case, acquiring entirely different companies.
Ah, I see.
By operating this way, the shrinking retail business doesn't really matter as much, because the primary value of the company is the massive pool of capital they are managing behind the scenes.
Okay, that reframes everything. Because if they are just a holding company in disguise, then what are they doing with that $9 billion war chest while they plan their next big move?
They definitely aren't just sitting still.
Right. We are seeing the formation of what you could call hidden moats. New, unconventional ways to protect the business.
Absolutely.
For example, they recently updated their Treasury reserve policy, and they now hold $519.4 million in Bitcoin.
Which is a textbook holding company maneuver in today's macroeconomic climate.
Really? Just buying Bitcoin?
Yeah, you diversify the treasury. Holding $500 million in Bitcoin protects the purchasing power of their cash against traditional fiat inflation.
Okay, that makes sense.
But more importantly, it captures asymmetrical upside.
Meaning they risk a relatively small percentage of their total treasury, but the potential upside if Bitcoin surges is massive and disproportionate.
Exactly. They risk $500 million to potentially make billions without ever putting the core $9 billion cash pile in jeopardy.
Meanwhile, the traditional physical gaming moat is eroding fast. I mean, you just don't need a physical disc to play a new release anymore.
No, everything is downloaded now.
Right. But CEO Ryan Cohen is building a new, quote-unquote, capital allocation moat.
It's fascinating to watch.
He is utilizing the premium valuation the company achieved during the whole meme stock era to access and deploy capital in ways that traditional legacy retail companies simply cannot pull off.
They don't have the cash.
Exactly. And while they plot these massive financial moves, they're launching these curious micro-catalysts.
Yeah, because they need tactical stalling maneuvers to keep the cash flowing.
Like the launch of power packs, or
Yeah.
these digital trading cards.
Yep.
And more noticeably, this nationwide rollout of retro gaming sections that hit their physical stores by early May.
That was a smart move.
They are actively sourcing and selling old Nintendo 64 and Sega Genesis games. And management notes that the profit margins on these retro games are incredibly high.
Very similar to their historically lucrative pre-owned disc business.
Plus, it relies on a physical browsing experience. Like, if you are a collector, you want to see the physical condition of an old game cartridge.
Right, you want to check the label for scratches before you drop $50 on it.
Exactly. That is an experience that Amazon or an online marketplace can't easily replicate.
No, they can't.
But look, I have to be honest. It feels a bit like the modern resurgence of vinyl records.
Okay, how so?
Like, it's a cool nostalgia trip. It's a great niche. But Is selling old Super Mario cartridges and hoarding $500 million in Bitcoin really enough to justify an $11.5 billion valuation?
Oh.
Or are they just desperately stalling for time?
Oh, they're absolutely stalling for time. But you have to understand the strategic purpose of that stall.
Okay, explain that.
The retro gaming initiative is incredibly smart, precisely because it isn't trying to be a $50 billion industry.
Right, it's just a niche.
The physical curation of retro games is a genuine, defensible niche moat, and what it does is generate high-margin cash flow right now.
Cash flow today.
Yes, that cash flow offsets the heavy losses they are taking from the decline in new game sales. It literally buys them time.
So they don't need it to be the whole business.
Exactly. They do not need retro gaming to justify an $11.5 billion valuation. They just need retro gaming to keep the lights on and the cash pile intact while they prepare for the true strategy,
Which is?
utilizing their massive capital for M&A mergers and acquisitions.
And that brings us to the core mystery of this entire situation.
The big reveal.
Right. They are hoarding cash. They are stalling with retro games. They're acting like a holding company. What on earth are they waiting for?
Well, now we know.
Yeah, last month, the Wall Street Journal finally gave us the answer. They dropped a bombshell report stating that GameStop is preparing a formal offer for eBay this month in May 2026.
It is the ultimate manifestation of the holding company pivot.
But the scale of this acquisition is staggering.
Yeah.
I mean, we are talking about a massive, almost comical mismatch in size.
Oh, total.
eBay's market cap is roughly $46 billion. GameStop, as we established, is sitting around $11.5 billion.
It's David versus Goliath.
It's a minnow trying to swallow a whale. The rumors suggest this is going to be structured as a leveraged buyout or an LBO.
Right. And macro trends are pointing to potential interest rate cuts later in the year, which would obviously make the debt financing for a massive buyout significantly cheaper.
It's perfect timing.
But for you listening, thinking about how corporate acquisitions normally work, this just sounds impossible.
It sounds like it shouldn't work.
Exactly. How does a company a quarter of the size actually pull off a takeover of a legacy tech giant without drowning in new onerous debt and destroying the very cash pile that makes them valuable in the first place?
To understand how the minnow swallows the whale, we really have to look closely at the mechanics of a leveraged buyout.
Okay.
It is a brilliant, highly aggressive piece of financial engineering. In an LBO, the acquiring company, so GameStop doesn't just use its own cash to buy the target.
They use someone else's money?
Essentially, yes.
Right.
It actually uses the assets and the future, guaranteed cash flows of the target company itself, meaning eBay, as collateral to secure the bank loans needed to buy it. Okay, let me see if I have this right. It's a bit like you wanting to buy a massive luxury high-rise apartment building.
Okay, tracking with you.
You don't have the full cash price, obviously.
Right.
But you show the bank the guaranteed future rent payments from all the current tenants.
Right.
And you use those future rent checks to convince the bank to give you the mortgage for the building.
That is the absolute perfect way to look at it. And in this scenario, eBay is the ultimate high-rise rental property.
Because they make so much money.
Exactly. Wall Street banks absolutely love lending against a company like eBay because its cash flows are incredibly steady, highly predictable, and very high margin.
Right. They don't have stores to run.
eBay operates a toll booth business model. They don't hold inventory. They just take a cut of every single transaction that happens on their platform.
But the income is super reliable.
Exactly. Because that income is so reliable, GameStop can preserve a large chunk of its own $9 billion cash pile, use some of it as an equity down payment, and then finance the rest of the $46 billion price tag against eBay's pristine balance sheet.
Wow. And suddenly, overnight, the fading mall retailer is just gone.
The metamorphosis is complete. If this leveraged buyout actually goes through, GameStop transforms into a diversified e-commerce giant instantaneously.
They just absorb everything.
Yep. They acquire eBay's massive global user base. They acquire their logistics network, their digital infrastructure, and their payment processing systems, all in one move.
So how is the market actually digesting this? Because Wall Street and retail investors are having an absolute field day trying to price an event that feels completely unbelievable.
The charts are fascinating right now.
Yeah, if you look at the charts prior to the Wall Street Journal news leaking, the stock had really stabilized.
It was very quiet.
It was digesting all that old historical volatility, trading in a very narrow, quiet range between $24 and $25. And that's within a 52-week range of roughly $20 to $36.
Right. Analysts call that a classic coiling pattern.
Like a spring.
Exactly. Think of a physical spring being slowly compressed tighter and tighter. The trading volume dries up, the price movement gets narrower, and the market is essentially holding its breath.
Waiting for news.
Waiting for a definitive piece of news to dictate the direction that spring will release.
Well, they certainly got their news. Because following the Wall Street Journal report, shares rocketed 4 to 7% in after hours, trading on massive volume.
It completely broke out of that consolidation phase.
And if you look at quantitative modeling, Simply Wallsaint estimates the stock is currently trading somewhere between 77.1 and 78.3% below its actual fair value.
Assuming this holding company pivot is real, of course.
Right, assuming it's real. But we are also seeing institutional heavyweights throwing their weight behind this.
That's the real signal.
CEO Ryan Cohen didn't just leak rumors. He bought an additional 500,000 shares with his own personal money in January 2026.
Which is huge. When an insider drops that kind of personal capital into their own stock, it is the loudest possible signal of conviction to the market.
And it gets even more interesting. Michael Burry, the investor famous for predicting the 2008 housing crash and the Big Short, he is holding a long-term position here too.
Yep, he sees the value.
But the most staggering detail to me is Ryan Cohen's compensation structure.
Oh, we have to talk about this.
He takes zero salary as CEO. $0.
Nothing.
His compensation is 100% at-risk options. And those options are explicitly tied to hitting a massive $100 billion market cap and $10 billion in EBITDA.
We really need to pause on that EBITDA number because it reveals everything about his strategy.
Okay, bring that down for us.
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's a mouthful.
It is, but it is essentially a measure of a company's pure core operational cash flow. A dying physical retailer cannot fake its way to $10 billion in pure operational profit.
Right.
You can't just pump the stock price on internet hype to hit that specific metric. Cohen doesn't see a single dime of his compensation unless he builds an underlying business engine that generates world-class historic value.
But you can feel the meme stock energy creeping back into the air, even if it's wearing a corporate suit and tie this time.
Oh, the energy is definitely back.
Because short interest on the stock remains highly elevated. So we have to address the elephant in the trading room.
Let's hear it.
Are we just looking at another speculative 2021-style short squeeze that is simply using a corporate acquisition as a convenient disguise?
It's the most common question being asked right now. And the reality is that it's a potent hybrid of both mechanics.
A hybrid?
Yeah. In 2021, the short squeeze was driven almost entirely by retail momentum and structural market plumbing. Like, retail investors simply overwhelmed the system and trapped the short sellers.
Right, it was just pure volume.
But this time, there is a real, tangible, fundamental corporate catalyst driving the pressure. The M&A strategy is real.
So the investors betting against the stock are staring down the barrel of an actual business transformation, not just a Reddit forum.
Exactly. Because you have a structurally bullish event, meaning the imminent acquisition of a highly profitable tech giant, the short sellers are being forced to cover their positions for a completely different reason.
They aren't just fleeing retail buyers.
No, they are fleeing because the fundamental thesis of their short position is suddenly entirely invalid.
Because the company changed.
Right. Betting against a dying brick-and-mortar store makes sense, but betting against a highly capitalized e-commerce holding company that just absorbed eBay, that is financial suicide.
Wow, yeah.
That combination of fundamental growth and technical short covering is what makes the upward momentum far more violent and, frankly, sustainable than pure speculation.
Okay, but we need to slow the momentum down for a second and look at the dark side of the moon here.
Fair enough. Always good to look at both sides.
Let's build the bear case. Because if this is such a brilliant, surefire strategy, what happens if the deal simply falls apart?
It could happen.
Because the execution and integration risks of a mega leveraged buyout are astronomical.
The risks are profound, absolutely. Integrating a $46 billion legacy tech company into an $11.5 billion holding company's corporate structure is incredibly dangerous.
It's like swallowing a bomb.
To go back to your high-rise rental analogy from earlier,
Yeah.
If you take out a massive mortgage based on rental income, and suddenly the tenants stop paying rent, or the building requires massive unexpected repairs...
You still owe the bank.
Exactly, you still owe the bank. If GameStop buys eBay and the expected synergies and operational efficiencies fail to materialize, GameStop could be left with massive share dilution, a completely unmanageable debt load, and a broken corporate culture.
Yeah, and even Ryan Cohen himself has publicly acknowledged the binary nature of this massive gamble.
He's been very open about it.
He recently called the move either, quote, genius or totally foolish.
Which is quite a thing for a CEO to say.
It really is. And there's a ticking clock hovering over the whole operation, too. There's unconfirmed speculation floating around Wall Street that if no acquisition is finalized within 12 months, GameStop might just throw in the towel on M&A entirely.
And do what instead?
Initiate a massive special dividend or a stock buyback.
Which brings us directly to the catalyst calendar.
Right. If you are watching this stock right now, the timeline you need to care about is incredibly tight.
Very tight.
The optimal target horizon is a 1 to 3 month swing trade. Everything is centered entirely around two specific events. First, the imminent bid announcement for eBay expected this month, May 2026.
That's the big one.
And second, the early June Q1 fiscal 2026 earnings report, where investors are going to aggressively demand operational detail.
They'll want answers.
But looking at Cohen's compensation structure, it looks to me like a pilot who only gets paid his salary if he lands a burning commercial airliner on a dime.
It's a high-wire act.
If eBay's board rejects the bid and the 12-month clock ticks all the way down without a deal, doesn't the hype completely deflate? Doesn't this leave everyday retail investors holding the bag on a shrinking video game store once again?
It is the ultimate risk, and any investor needs to weigh it carefully. If the eBay deal fails to materialize, the immediate speculative momentum will fracture, and the stock will likely take a hit.
Right.
However, the catastrophic downside risk is heavily mitigated by two critical factors.
Okay, what's the first one?
First, as we discussed, Cohen's compensation structure.
The zero salary.
Yes. He legally and financially cannot benefit unless the deal creates massive sustainable shareholder value. He isn't going to force a terrible debt-ridden deal just to get his name in the news because a bad deal ruins his own payout.
Because he needs that $100 billion market cap.
Exactly. He requires that $100 billion market cap to win.
So he's fully aligned with the retail investor holding like 10 shares in their brokerage account?
Completely aligned. He's in the exact same boat. And second, that rumored special dividend you mentioned?
Yeah.
It acts as an ultimate structural safety net.
How so?
Well, if they scour the market and simply can't find an acquisition target that makes financial sense, they are still sitting on $9 billion in cash.
Right. The cash doesn't disappear.
Exactly. A massive special dividend would immediately reward investor patience and prevent a total collapse of the stock price. It establishes a very hard floor beneath the company's valuation.
Okay, I see.
Even in the absolute worst-case scenario where they fail to buy anything at all, they aren't going bankrupt anytime soon.
Pulling all of these threads together, we are looking at an incredibly compelling 8 out of 10 bullish investment thesis.
I'd agree with that rating.
The primary takeaway from this deep dive is that you simply cannot evaluate GameStop as a mall retailer anymore.
It's a totally different beast.
It really is. It is a highly capitalized, aggressive investment vehicle actively demanding a market re-rating as it attempts one of the boldest, most audacious corporate acquisitions in modern financial history. For you listening, keep your eyes absolutely glued to the financial news feeds for that imminent May buyout bid, and make sure you mark your calendars for that critical June earnings call.
It really is a defining moment for the company. And I want to leave you with a final thought to mull over as you watch this play out over the next few weeks.
Let's hear it.
We've spent a lot of time today talking about the financial mechanics of this specific deal. You know, the LBOs, the holding company structures, the short interest.
All the plumbing.
Right, the plumbing. But zoom out for a second and look at the cultural shift.
Okay.
If GameStop actually pulls this off, if they use a war chest fueled entirely by internet retail enthusiasm, Reddit forums, and meme stock culture, if they use that to literally buy out a foundational legacy tech giant like eBay, what does that mean for the future of capital markets?
That is a big question.
Are we entering an entirely new era where everyday retail sentiment doesn't just disrupt Wall Street from the sidelines, but actively buys it out from underneath them?
Wow. Now that is a thought that will keep you up at night.
It definitely changes the game.
It really does. Thank you for joining us on this deep dive. We hope you walk away feeling uniquely well-informed on one of the most complex, fascinating financial stories of the decade. Until next time.